So today is July 17th, 2026. And if you are looking at the financial news today, it is pretty grim.
Oh, it's a mess out there on the screens.
Right. I mean, the headlines across basically every network right now are just screaming bloodbath
Yeah, that's the favorite word today.
because the KSE 100 index just crashed. It dropped by over 2,320 points.
Which is, a massive number to see flashing in red.
It really is. It closed at 175,802.78. That's a 1.30% decline just
Wow.
today. But, and this is exactly what we're going to get into for this deep dive, if you actually know how to read the underlying data, you might see something completely different.
Absolutely. I mean, this is the ultimate paradox of financial media, right?
Oh, totally.
The headline numbers that they broadcast on a day like today, they're specifically designed to incite, well, a little bit of fear, because fear captures attention.
Right. It keeps you glued to the television ticker.
Exactly. And a 2,300-point drop sounds catastrophic, but you have to remember an index is really just a mathematical average.
And averages can lie to you,
They are incredibly skilled at lying to you.
which is the whole mission for our deep dive today. We've got this fresh stack of charts directly from our sources covering the Pakistan Stock Exchange, the PSX.
Yeah, lots of fresh data to go through.
And we are going to translate all these messy red and green candlesticks into an actual story for you. We want to look past that flashing red KSE 100 headline.
Because when you peel back the layers of a 2,300-point drop, you really don't find a unified market in panic.
No, not at all. You find this completely fractured landscape.
Right. And to understand that fracture, I think we have to start by zooming out.
Let's do it. Contextualize this drop for us.
Right. So looking at today's intraday low, which hit 175,790.62 in a vacuum, that is exactly how investors get shaken out of perfectly good position.
Yeah, they just panic sell.
Exactly. And yes, the index has been on a downward slide recently. I mean, we peaked near the 190,000 mark.
Which is huge.
It was. So dropping down to 175,800, well, it hurts. But we have to look at the broader historical consolidation.
And I'm looking at the exact chart from our sources right now, and the contradiction is just, it's staring us right in the face.
It is pretty glaring.
It really is. Despite today's bloodbath, the trailing one-year change is still overwhelmingly positive. We are up 26.78%.
Which is a massive move for a single year.
And the 52-week range is staggering. We moved from a low of 136,674.988 all the way to a high of 191,032.73.
Right, so we are sitting incredibly high relative to where we were just 12 months ago.
So, okay, let me unpack this for a second. Looking at that one-year chart versus today's drop, it's kind of like worrying about a single pothole when we're already like halfway up a mountain.
That is a perfect analogy, yes. When an index rallies over 50,000 points in a year, the market absolutely requires periods of aggressive consolidation.
It has to sort of catch its breath.
Exactly. It has to shake out the weak hands, let the institutional buyers establish new bases. You hit a bump, the car shakes, it feels violent, but your overall altitude on that mountain is still drastically higher.
I hear that.
Yeah.
I do. But I'm looking at another metric in our data stack here, and I have to push back a little on that bullishness.
Okay, let's hear it.
The year-to-date change.
Yeah.
For the entirety of 2026 so far, the KSE 100 is sitting at this barely visible positive 1.00%.
Right.
So if we're only up 1% for the whole year so far, I mean, hasn't the momentum just totally stalled out?
That is a highly valid pushback. You are not wrong to look at that 1% figure and just feel completely underwhelmed.
It's a pretty boring.
It is. The broader index momentum absolutely has stalled. But here's the critical distinction you have to make. A stalled index does not equal a stagnant market.
Wait, what do you mean by that?
Well, when the headline number flatlines at 1%, it usually means we have entered a period of intense sector rotation.
Okay, so the money is just moving around.
Exactly. Capital isn't leaving the market. It is aggressively shifting from one industry to another.
So some sectors are soaring while others are crashing.
Yes, and mathematically, they are just canceling each other out to create that boring 1% average on the surface.
Which brings us to the really fun part of this deep dive. Because if the macro index is lying to us through averages, we have to look at the divergent stories happening inside the specific sectors.
We have to look under the hood.
Exactly. Let's start with the cement industry. It is literally the foundational building block of the economy.
A very heavy sector, yeah.
And the data split we have here is absolutely wild. If the macro environment is identical for all these companies, the chart shouldn't look this different, right?
They really shouldn't. Cement right now is basically providing a masterclass in why the market of stocks theory overrides the stock market theory.
Okay, break that down for us.
Well, when you look at the technical accumulation happening in parts of this space, it completely contradicts the narrative of a market crash.
Yeah, I'm looking at the steady climbers
Right.
first. Fauji Cement, ticker FCCL. It's sitting at 53.78, and it's just locked into this clear, upward sloping parallel channel.
Just marching higher.
Just march. And then Maple Leaf Cement, MLCF at 95.50. Same thing, bouncing along an upward trajectory. And that is cement, THCCL, at 68.25. Also safely inside an upward channel. So the KSE 100 is bleeding today, but these three are showing textbook resilience.
And what you were seeing there in FCCL, MLCF, and THCCL, that is institutional conviction.
Meaning the big players are buying.
Exactly. When a stock trades in a defined upward channel like that, especially on a day when the broader market is selling off, it tells you that algorithms and large funds are actively accumulating shares.
So every time the price dips, they just scoop it up.
Right. Every time it hits the lower boundary of that channel, they buy. They aren't trying to time some massive breakout. They are methodically absorbing the supply.
Putting a bid wall underneath the stock.
Precisely.
And here is where it gets really interesting for you listening. If Fauji and Maple Leaf are climbing this steady staircase in the exact same economy, then the next chart makes absolutely no sense.
The giants fall.
Yes. Lucky Cement, ticker LUCK, it's a major player, and it is currently sitting at 447.0.
And the chart is a disaster.
It's an absolute disaster. Unlike the others, it has this vicious recent downward spike. It broke sharply away from the 480-plus levels it was holding.
Right. It just fell off a cliff.
How does that happen? How can three of them climb a staircase while Lucky Cement basically jumps out a window?
Well, this is where you have to differentiate between channel followers and breakdowns. When you see a breakdown of that magnitude in a single company, while its direct peers are thriving, you are usually looking at a company-specific liquidity void.
A liquidity void, so the buyers just vanished.
Exactly. The institutional buyers who were previously defending that 480 level simply pulled their bids.
Why would they do that?
It could be an internal earnings projection, maybe a debt restructuring concern, or just a major fund rotating out of their specific position. Whatever the reason, the floor just vanished.
Okay, let's connect the math here for the listener.
Yeah.
Because I think this ties directly back to our 2,300-point index drop that we started with.
It ties back perfectly.
Because Lucky Cement isn't just another cement company, it's a heavyweight.
Right. Its market capitalization is massive compared to the others.
So because the KSE 100 is a capitalization-weighted index, LUCK falling off a cliff is going to drag the entire index down with it.
Disproportionately so. You've hit on the exact mathematical illusion of the KSE 100 here.
It's all about the weighting.
Exactly. Market cap weighted indices are not democracies. They are plutocracies. The biggest companies have all the voting power.
Wow.
So a violent drop in a heavyweight like LUCK destroys the index math. It actively pulls the headline average down.
So someone turns on the news, sees the KSE 100 drop, and thinks the whole cement sector is dying.
Right. But when we look at the data, 3 out of the 4 charts are showing incredibly healthy accumulation.
One giant tripping over its own feet basically masks the fact that the rest of the sector is doing fine.
Exactly.
That is fascinating. But let's see if this divergence is isolated just to cement or if we can see it elsewhere. Let's pivot over to energy and power.
That's a great sector to look at next.
Because energy is the fuel that powers the economy.
Right.
And it's notoriously sensitive to macro trends. So if there's real panic, it should show up here.
It's the perfect stress test. You're dealing with heavy regulatory stuff, massive infrastructure debt.
Yeah.
But even here, the charts are ignoring the macro noise.
I see that.
Oh.
Look at Pakistan State Oil, PSO. It's currently trading at 347.69. And this chart is incredibly neat.
It's a technical analyst's dream.
It really is. It's trapped in this massive upward sloping channel. And the price just recently touched the bottom support line and bounced straight up.
And that bounce is profound.
Why is that?
Because it reveals the underlying psychology of the market. That support line isn't just an arbitrary line drawn on a screen.
Right.
It represents a historical liquidity zone. It's the exact price point where institutional capital has determined the stock is simply too cheap to ignore.
So when it hits that price, they flood the system with buy orders.
Exactly. Overpowering all the fearful retail sellers who are panicking over the KSE 100 headline.
It's like dropping a golf ball on a concrete floor. The bounce is just immediate.
Perfectly said. But then...
Yeah, let's look at the contrast. Nishat Union Power, NCPL.
Right.
currently at 58.04. And if PSO bounced off concrete, NCPL basically stepped on a trapdoor.
It completely shattered its floor.
Yeah. I mean, looking at its recent history, it was hitting resistance way up at 65.81, and then it just fell through the floor down to the 53 level.
And now it's trying to stage this really weak recovery.
At 58.04, yeah, the volume looks terrible. These two charts just feel so wildly different.
Which completely dismantles the idea of passive sector investing.
Right, like saying, I want to buy energy because the grid is expanding.
Exactly. You can't just buy a generalized concept like energy and expect uniform results.
Because you're buying individual company trajectories.
Yes, PSO has the structure and institutional backing to maintain that supported trajectory. NCPL's trajectory is totally fractured.
So if you bought NCPL hoping it would act like PSO, today's market is severely punishing you.
Unforgivingly, yes.
Man. Okay, let's move to our final data sets. We've looked at the steady climbers, the heavyweights breaking down, the clean support bounces. Now, we need to look at the absolute wildcards.
The extremes.
Yes, the extremes happening underneath today's drop. We're going to contrast extreme volatility with quiet consistency.
Because this is where we separate the thrill seekers from the long-term compounding capital.
Right, let's talk about the roller coaster first. Gandara Automobiles, ticker GAL.
Oh, this chart is wild.
It's absolute chaos, sitting at 572.000 today. If you look at the chart history from late June and early July, it doesn't even look like a functional market.
It looks like a heart monitor.
Yes, you had these massive vertical green spikes pushing the price well over 600, and then they are instantly followed by these aggressive, violent red drops right back down.
It wipes out all the gains in a matter of hours.
What is actually driving that kind of behavior?
Pure speculation. Those massive vertical spikes are rarely driven by fundamentals. They're usually an influx of highly leveraged retail buying or rumors or day trading syndicates trying to force a momentum breakout.
So they overwhelm the buy side, the price shoots vertical.
And then there's zero conviction behind the move. The very same traders who drove the price over 600 have their algorithm set to take profit. The moment the buying pressure slows down, they dump their shares.
Just flooding the sell side.
Exactly. There are no real long-term buyers at 600 to absorb that supply, so the price crashes right back down.
It's a zero-sum game of musical chairs.
A very dangerous game.
You buy at 600, thinking you caught the breakout, and an hour later, you are bag holding at 570.
I'm feeling pretty sick about it.
So if Gandara Autos is the terrifying roller coaster that makes you lose your lunch, let's look at the complete opposite.
The escalator.
The escalator. Pakistan Telecommunication, PTC. It's sitting at 71.10. And compared to GAL, this chart is incredibly orderly.
It's almost boring.
It really is. It's basically the escalator at the mall, just slowly and steadily taking you to the next floor. It's just marching toward the upper resistance band of its upward channel.
And see, boring is exactly what smart money is looking for.
Really?
Oh, absolutely. The wild swings in an auto stock like GAL, they draw all the attention. They trend on social media. They trigger all the trading alerts on your phone.
Right, because of the volume.
Yeah, but the risk-adjusted return is terrible. You're constantly fighting algorithms. But a telecom giant like PTC, the quiet escalator.
It doesn't make the evening news.
No, it doesn't. But this is where steady trends live. Institutional money, like pension funds, they can't trade a stock like GAL.
Because there's not enough real liquidity.
Right, they'd spike the price themselves just trying to enter, so they look for a PTC. They slowly accumulate shares over months, which mathematically creates those predictable upward channels.
They just quietly build their position, regardless of what the KSE 100 headline says today.
Exactly.
Wow. It is just fascinating to realize that all of these completely contradictory stories are playing out simultaneously on the exact same exchange.
On the exact same day.
Yeah. Let's pull all of this together for you listening, because the narrative we started with has basically been turned completely upside down.
It really has.
We started with this frightening headline. July 17, 2026, the KSE 100 dropping over 2,300 points.
Right, a headline begging you to panic sell.
But by unpacking the sources and reading the charts, we saw that this single red number hides a totally complex web.
We found steady upward channels in telecom with PTC and parts of the cement sector with Fauji and Maple Leaf.
We found textbook support bounces in energy with PSO.
And we also identified the specific things dragging the index down. The market cap weighted damage from Lucky Cement breaking down.
And the wild volatility traps in autos with GAL.
Right, so the index average doesn't just fail to tell the story, it actively obscures the reality.
It really does. But before we wrap up, I know you had one final thought you wanted to leave the listener with today, something to kind of mull over regarding these index numbers.
Yeah, I do. We spent this whole deep dive talking about how a heavyweight like Lucky Cement dragging down the index masks the success of smaller companies, right?
Right.
Well, consider what happens when the exchange conducts its routine index reconstitution.
Oh, interesting.
What happens if a struggling heavyweight is eventually removed from the index entirely? Or if they alter the mathematical weighting formula to cap the influence of those massive companies?
Wait, if they alter the formula, the math of the index changes overnight.
Exactly. The KSE 100 could suddenly print a massive recovery rally the very next morning.
Without a single underlying company actually changing its valuation.
Precisely. The media narrative would shift from fear to greed instantly, and the market would appear fixed simply because the math was adjusted.
That is wild.
So the next time you hear on the news that a major index is crashing or miraculously recovering, remember how easily those numbers are manipulated by structure.
Ask yourself which market is actually crashing.
Exactly. Don't ask what the market is doing. Dig into the charts and ask how the market is being measured.
That is a brilliant framework to keep in mind. It really makes you question everything on that surface-level news ticker.
You have to look past the surface.
Always. Well, thank you for joining us on this deep dive into the real mechanics of the PSX. Keep questioning those numbers, keep looking at the actual data, and we will catch you on the next one.